Most people think market crises arrive with sirens and headlines. They don't. They arrive quietly, buried inside spreadsheets, warehouse reports, and numbers that almost nobody bothers to read. And by the time those numbers make the news, the outcome is already locked in. What's happening in silver right now feels exactly like that kind of moment. The calm before a collision that, once it happens, can't be undone. On the surface, silver looks like it already had its moment. A violent run-up, a sharp crash, and now a period of uneasy calm. To most observers, that story feels finished. Bubble inflated, bubble popped, move on. But that interpretation misses what actually matters. The real story isn't the price you see on a screen. It's the growing tension between a paper-based market structure and a physical supply system that appears increasingly stretched. At the heart of this market is a simple promise. Futures contracts are supposed to represent real metal. In normal times, that promise is mostly theoretical. The vast majority of contracts never result in delivery. Traders close positions, roll them forward, or settle in cash. Physical demand stays manageable, and the system hums along. Problems only arise when too many participants decide they don't want paper exposure anymore. They want the metal itself. That shift in behavior seems to be accelerating. Recent delivery activity suggests that an unusually high share of contract holders are choosing allocation over cash settlement. That alone wouldn't be alarming if inventories were rising or even stable, but they're not. Available silver in exchange vaults has been declining for months, and the pace of that decline has been faster than what most futures markets experience under normal conditions. When inventory falls steadily while delivery demand rises, it creates a math problem that no amount of confidence can solve. The issue becomes more serious when you consider timing. Futures markets operate on schedules, and certain dates force decisions. As those deadlines approach, traders must declare whether they intend to roll, close, or stand for delivery. When inventories are thin, every declaration matters. Even a relatively small percentage of contracts converting into physical demand can strain the system. And once confidence in delivery weakens, behavior can change very quickly. Price action often disguises this process rather than revealing it. Sharp sell-offs are commonly interpreted as a sign that pressure has been released. In reality, sudden declines can serve a different purpose. They reduce open interest, force leverage players out, and buy time for the system. History shows that similar price collapses occurred during previous silver bull markets, not at the end of them, but in the middle, right before the most intense phase. What makes the current environment distinct is context. In earlier episodes, exchanges still had ample metal. Rule changes, margin hikes, and trading restrictions worked because physical supply existed as a backstop. Today, inventories appear significantly lower relative to the size of the paper market. That doesn't guarantee failure, but it narrows the margin for error. Structural stress becomes harder to manage when supply flexibility disappears. Another signal often overlooked by retail investors comes from the lending market for physical silver. Lease rates, the cost to borrow metal rather than money, are typically quiet, boring numbers. Most of the time, they barely move. When they spike, it suggests urgency. Someone needs metal now, not exposure, not promises. Elevated lease rates don't prove a shortage on their own, but they do imply that access to physical silver is becoming more expensive at precisely the moment when delivery demand is rising. This tension isn't limited to one exchange or one country. Physical markets are global, but they're not frictionless. Taxes, transport costs, insurance, and regulatory barriers can isolate regional prices from one another. When those gaps widen instead of closing through arbitrage, it indicates that metal isn't moving freely. That kind of fragmentation tends to appear when supply chains are tight and holders become reluctant sellers. All of this creates a fragile equilibrium. Paper prices can still move lower. Volatility can still flush out weak hands. None of that contradicts the underlying issue. In fact, it may reinforce it. Each wave of volatility tests whether participants trust the system enough to stay in paper form. Every test that pushes more demand toward physical settlement increases stress on the remaining supply. It's important to be clear about what this does and doesn't mean. Markets can remain strained longer than expected. Institutions have tools, and rule changes are always possible. Outcomes are not predetermined, but structures matter. When claims grow faster than the assets backing them, eventually something has to adjust, either behavior, pricing, or confidence. Silver has reached moments like this before, but the surrounding conditions were different. Today's environment combines heavy financialization, thinner inventories, and global demand that isn't easily turned off. That combination doesn't guarantee a dramatic outcome, but it does expand the range of possibilities. And wide ranges are what make markets uncomfortable. This isn't a story about predicting prices. It's about understanding mechanics. When paper markets drift too far from physical reality, resolution tends to arrive suddenly, not gradually. That's why paying attention now matters. Not because a specific outcome is certain, but because uncertainty itself has become unusually high. And in markets, that's often the most important signal of all. At some point, every market faces a moment where belief is tested. Not belief in prices, but belief in the system itself. Silver may be drifting toward one of those moments now, and the reason has very little to do with charts or headlines. It has everything to do with what happens when a promise meets a physical limit. Futures markets work because most participants agree to treat them as financial instruments, not delivery mechanisms. As long as contracts are rolled, closed, or settled in cash, the system remains efficient and liquid. Trouble begins when that assumption quietly breaks. When enough traders start asking a simple question, can you actually deliver what this contract represents? The entire structure starts to feel different. If an exchange were ever unable to meet delivery requests, the response wouldn't be dramatic in the way movies imagine. There are procedures. Contracts can be settled in cash instead of metal. Rules can be adjusted. Trading can be paused. From a legal standpoint, those options exist for a reason. From a credibility standpoint, they come at a cost. Cash settlement may resolve the immediate problem, but it also sends a message that the contract is no longer a direct claim on the underlying commodity. Once that line is crossed, futures stop being a proxy for physical reality and become something closer to a financial wager. We've seen versions of this before. In stress moments, exchanges have rewritten rules to prevent disorderly outcomes. The nickel market disruption a few years ago is a useful reminder. The market survived, but confidence didn't fully recover overnight. Participants learned that extreme conditions can lead to extraordinary interventions. That lesson lingers. What makes silver especially sensitive to this dynamic is its supply profile. Unlike many commodities, silver has been running persistent deficits in recent years, meaning global consumption has exceeded new supply. Those gaps have been filled by above-ground inventories, recycling, and stockpiles that are finite by definition. Over time, that drawdown matters. It reduces flexibility just when demand becomes less optional. Silver is not only a monetary metal, it's an industrial input embedded deep inside modern infrastructure. Solar panels, electronics, data centers, and electric vehicles all rely on silver's unique properties. In many of these applications, there is no perfect substitute. Manufacturers can adjust designs at the margins, but they can't simply remove silver without sacrificing performance or reliability. That makes a large portion of demand relatively insensitive to price, at least in the short and medium term. On the supply side, higher prices don't guarantee a quick response. Most silver production comes as a byproduct of mining other metals like copper and zinc. That means output decisions are driven by those markets, not silver itself. Primary silver mines exist, but bringing new ones online is a slow, capital-intensive process, measured in years, not quarters. Even optimistic scenarios struggle to close large structural gaps quickly. Layer geopolitics on top of this and the picture becomes even more complex. Refining capacity is concentrated, and trade policies can redirect metal flows almost overnight. When large producing or refining nations prioritize domestic needs, global availability tightens further. These decisions are rarely framed as market interventions, but their impact is felt just the same. All of this feeds into a subtle but important shift in behavior. When market participants suspect that physical supply is becoming scarce, they tend to hold rather than release metal. That hoarding instinct isn't emotional, it's rational. If confidence in paper settlement weakens, physical ownership becomes more valuable precisely because it removes counterparty risk. The result can be a two-tier market where quoted prices reflect financial contracts, while actual metal trades at premiums determined by availability and urgency. None of this means a dramatic breakdown is inevitable. Markets are resilient and institutions adapt. But resilience has limits, especially when multiple pressures converge at once. High delivery demand, constrained inventories, elevated borrowing costs for physical metal, and fragmented regional pricing all point to a system under strain. Strain doesn't equal failure, but it does increase the probability of unconventional outcomes. The most important takeaway isn't about predicting what happens on any specific date. It's about understanding why uncertainty has widened so much. When systems operate smoothly, outcomes cluster tightly. When they don't, the range of possibilities expands. That's where we appear to be now, not at a conclusion, but at an inflection point where confidence, rather than price, becomes the variable to watch. If an exchange can meet its obligations, the system carries on, perhaps bruised but intact. If it can't, even temporarily, the consequences ripple far beyond a single commodity. Trust, once questioned, is slow to rebuild, and in markets built on promises, trust is the real collateral. Silver may simply be the lens through which this tension becomes visible, or it may be the catalyst that forces uncomfortable questions about how modern markets function when physical reality pushes back. Either way, moments like this are rarely obvious in real time. They only look obvious later, when the numbers that once whispered finally speak out loud.